Welcome to Focal Point, a show where we invite thought leaders from business, government, and our communities to share with us their journeys of success and failure, innovation and entrepreneurship, as well as their visions for Hong Kong and the world. Hi, welcome to Focal Point. This is our third episode, and we are very fortunate to have with us Mr. Yat Siu, who is the chairman of Animoca Brands, one of the leaders in Web3 based in Hong Kong. So we're very proud to have him with us today. And yet, I guess I have to jump right into it. It's, the timing of the interview is impeccable, almost, Indeed. In some ways. We started talking a year ago, talking about Web3 and kind of introducing to people a year ago what you were doing, what the firm was doing. And as you said, this is dog years. So 1 year has been like, what, 6, 7 years?
That's right.
A lot has changed. I have to go straight to the elephant in the room. Last week, something major happened in the industry with FTX. I bet you all the audience, everyone's watching, would love to know what exactly happened. How does it impact the industry or your firm, and what you are doing to, I guess, handle it, managing the people, or as an investor in the ecosystem, how do you handle all this? But without further ado.
Yes, well, thank you. It's a great pleasure talking to you again. One of the crazy things about, as you say, crypto is that, and blockchain space is that it is dog years. Because some people may have already forgotten that it was less than half a year ago that we're actually dealing with Terra and Three Arrows, right? And then before that, so you had a number of things in the space that really sometimes seem to be quite sort of cataclysmic. But I think for FTX, I think the issue with FTX, and I'll get into the specifics, but the issue for FTX, why it seems to be so much bigger, even though financially the impact isn't nearly as large, right? If you think about what happened for Terra and Luna, macro aside, almost $2 trillion of value basically was sort of wiped out. Whereas actually, in this case, market-wise, it hasn't had quite the same impact. In fact, it was fairly minimal in terms of the macro. Also, the kind of people who trade on FTX are basically professional traders for the most part. Right. So yes, institutions were infected, VCs were affected for sure, and traders were affected. But the general market, the general user, doesn't trade on FTX. The people who are basically owning NFTs and playing in the sandbox or Phantom Galaxies, they're not affected, right? They don't trade outside of the macro. Right? So it hasn't had that much of an impact in terms of the way that, say, Terra and Three Arrows had. But because SBF was so prolific, and because everyone thought of him as essentially the face of crypto, he basically became that symbol. And so when he fell, what really fell wasn't so much, the underlying of sort of crypto. In fact, if anything, it strengthens the argument for decentralization. It actually just became a symbol of, well, if this guy fell, if the so-called king of crypto fell, then is crypto gone, right? That's really the symbolism around it. And that's a little frustrating because, as it turned out, everything that SBF stood for was everything but crypto wasn't. Right? He was centralized. Right. He was cooking the books. Right? He was a fraudster. He wasn't transparent at all. He wasn't thinking about democracy at all. All this altruism stuff. It turned out he was openly saying it was bullshit. I mean, so he went out and basically lied about everything, right? To sort of get to what he wanted to achieve, right? Which really you can say is sort of greed, power, and obviously underlying to any mechanism to get there, which is basically always fraudulent. Now, how does it affect the industry? I think, maybe just specifically what happened was that he basically, did insider dealings with his own firm between Alameda and FTX. You can go online and see all the sort of gory details. I think the bankruptcy sort of expert who became, basically the interim CEO said that he has never ever seen a case this unprecedented and this ridiculous. And this was the guy who actually managed Enron. Right? Oh boy. So now again, the scale of damage is not as large as Enron in terms of absolute figures, but it was just the kind of messiness, the fact that money was sort of spent that didn't exist. For instance, that basically they were trading customer funds. Gave it to sort of Alameda, which was another fund of was a market maker. Basically, just did whatever they wanted with it, and basically treated actual people's money with complete disrespect. And obviously, the fact that he was able to create these backdoors, which is what the story is now, that he was able to sort of funnel funds in and out and basically really conduct fraud at the investor level. So when investors would do DD, they wouldn't, or the auditors would look at the numbers, they wouldn't actually be able to see what's real because of the fact that they did some kind of backdoor mechanism. All that kind of stuff, to me, tells me that actually what he was doing was perpetrating fraud right from the beginning.
Wow.
So in other words, this wasn't the case. The common story would be, he got in over his head, right? The business grew too fast and over-leveraged, it was a mistake. I think it turns out to be not the case at all. Basically, it started with a lie and ended with a lie, right? And so the whole thing was basically just fraudulent right from the beginning because he created these mechanisms in which he could basically literally sort of present numbers that weren't there, right? And so that's what seems to be emerging. So actually, I think, to me, SBF and FTX actually is the enemy of crypto. It's the enemy of blockchain because what he represents is everything that blockchain isn't. And again, just like what happened with Terra and Luna 6 months ago, all the centralized systems where you had no transparency, where you couldn't see what was going on, they fell apart. But the ones that were on-chain, they did exactly what we knew would happen, and they functioned as intended. Right? So I think really the argument here, if there is a silver lining to all this, is that now sales of Ledger and hardware wallets is on a record high, right? And I think something just last week, an additional $1.5 billion of crypto went out into basically decentralized storage, so self-custody, which actually I think is a good thing because what it means is that people are becoming aware of the need to basically have your own tokens and have self-custody as well. That's not to say you can't trust certain parties, but that you understand that the meaning of decentralization means that you need to sort of distribute your assets, in a better way, and also understand the ownership aspect of it, as opposed to just giving it to someone.
But isn't that an issue that's kind of difficult for the industry, for an industry who's trying to go mainstream? Because what happens is, I do know a lot of people who are experts in the space, they move their coins into cold wallets.
Yes.
But let's say for most of us, we don't know what cold wallets are, don't know how to move it in there, right? So that's why people open accounts with FTX, with Coinbase and all that, because it is precisely because it's a central exchange and you feel safer with these guys. So now this happened, where people say, okay, well, let's just forget it. We don't want to deal with crypto anymore.
Well, I mean, the interesting thing is that the number of people who are joining the space, not for trading, but for playing games or being in the metaverse, like the Sandbox, for instance, they have to have basically wallets anyway, because they can't do it in a centralized exchange. It's just that they don't have a lot of value in it, right? So it might be worth hundreds of dollars. It's not worth, hundreds of thousands of dollars. Therefore, the risk might be implied to be differently. I think it's very important that people do understand what decentralization and sort of cold storage means. That's not to say that you have to cold store everything. It just means that you have to know how to do it. Because actually storing your assets in a cold store wallet is easier than opening a bank account. It's actually not that difficult. It's inconvenient. It's something you don't understand. It's something like, oh, do I have to do this? But how many people have a safe in their home? How many people sort of put their valuable assets somewhere that they think is safe, whether it's in their home or in their office or something like this? I don't think it's that different, really. That is not to say that you shouldn't put your money into, say, something like a Coinbase, which I think is very safe, for instance, because they're regulated and they have a clear demonstration of the stuff. One of the issues is that in places where there's a lack of regulation, people are saying you can't stop this. They want to trade in this. They want to own these assets. So both with a lack of education and with a lack of regulation, then they will go to these rogue players. And there's a reason why FTX is sitting in Bahamas, right? And one of the things, if you think about it, is that now what Hong Kong is trying to do to become a virtual asset hub, if they have positive and transparent and good regulation, actually what will happen is that good exchange players will come here and actually present themselves in a manner that then can be properly regulated and institutionalized. And then people can have trust as well. It's because there's a lack of clarity that it drives people away. And then, instead of trusting, we authorize this institution because they follow the laws, we then have to go with the person that has perhaps the best media presence, which is basically what FTX became. And that ended up becoming dangerous, very dangerous for that matter of fact, right? So I think that's important. And if anything, this has created urgency, because I think there's one thing we can say is that blockchain and crypto and Web3 is not going away, right? There's of course the negative voices, the critics have all come out now and said, told you so, as they do, right? But then they disappear, as they have done 6 months ago, as they have done 2 years ago or 4 years ago, because they don't like the space. but actually underlying, more people are entering the space, right? And so the approach to protect them is not to try to remove it outright, which is what some more old-fashioned people would try to do, but actually is to actually bring in basically the appropriate sort of regulatory forces to make sure that's clear, right? And there's the bigger picture. We discussed this earlier, but I think it's worth iterating, which is that what this is about, ultimately, blockchain, right? So the tech side of blockchain is digital ownership. Mm-hmm. And digital ownership is at its core. Cryptocurrency is only one element of that ownership.
Right.
It's a transactional layer for it, but it's not necessarily the main reason we do it. And so I think everyone will say, well, we need to have control of our digital lives, don't we? We need to have digital sovereignty. We need to have sort of a way in which we have independence to decide what happens to our data, that we shouldn't be dependent on Facebook or dependent on third-party platforms who rule over us. And so that's really the movement. And I think most people would agree that that's actually a good thing. But then coupled with the whole cryptocurrency thing and the speculative aspect is where it gives it a little bit of sort of that distastefulness, which then is where regulation is needed. Yeah.
But then what do you recommend then? It's as a thought leader in the industry, is it now that SFC in Hong Kong should be the one regulating digital exchanges, the SSC and SEC in the US would do that? Is that what's going to happen, you think?
I think there's going to be distinctions between the kind of sort of digital assets that should be regulated. For instance, probably NFTs won't be regulated in this manner because it's like owning a house or owning a car. But for instance, for fungible tokens, particularly the ones that have security-like qualities, there needs to be a regime. So we know what that is, because right now there is nothing for the time being. But I think Hong Kong has come out and said that they want to be a virtual asset hub. I think they've already started giving out licenses and procedures around this. So I think that's a good sign. And I think it's also a great sign for Hong Kong, because Hong Kong has now sort of been a little bit sleepy before and now has come back in full force and said, we want to be a leader in this space and we understand it. One of the sort of impressive things about Hong Kong is about a year or so ago, we started getting involved we really sort of pioneered and got involved in the NFT space with CryptoKitties, which is almost 5 years ago now, which is, if you think about it, it's like incredibly long, right?
Yeah.
When NFTs started to get popular around the world, which was really in late 2020 and early 2021, Hong Kong still didn't know, people in Hong Kong still didn't really know what NFTs were. They were like, what is this? Don't know what this is. And now you have NFT art galleries, you have startups, you have companies, like everyone knows what an NFT is. Maybe they have one already, everyone's talking about it, from celebrities to lay people. And this is, I think, very interesting about Hong Kong, which is that when news like this travels and adoption happens, Hong Kong has typically always been the place where adoption is the fastest and therefore the awareness.
Right.
I think Hong Kong was perhaps also the first place where there was a more than sort of had the highest mobile phone penetration that exceeded a ratio of 2 to 1, for instance, right?
Same with EVs.
Yeah, exactly, right? So Hong Kong always had that quality. And so therefore I think as a sort of first mover advantage, you can actually sort of really benefit from this. And I think Hong Kong as a government realizes this, which is why they've started to come up with much more progressive policies around it.
But let's go back to the investment side a little bit, because I know Animoca does a lot of investing across the industry, across the ecosystem.
Yeah.
From an investor's perspective, what did this incident do? I think part of the things I could imagine is that confidence is a little bit damaged. People are a little bit worried about which one's real, which one's not.
Yes.
I think some values were probably lost in some companies. Perhaps fundraising is now becoming a bit more difficult, right? I mean, a lot of this is just human nature, just reaction to what's happened. So from an investment perspective, an investor perspective, what's happening? What are you guys doing?
Well, I mean, first of all, it's for sure investment has slowed down, right? And the reason why is people want to see what the fallout is. It's not, it's interesting thing is it's not that people don't believe in Web3. People are still wanting to deploy money in Web3 and blockchain or metaverses. That's not the issue. The issue is just trying to understand who are the ones that have been affected by this. Right. Now, with FTX, we think the fallout will take a couple more weeks, and then we'll really see who's affected, because the sort of ripple effects basically will come out very quickly, because everyone, this is the other effect, unlike what happened with Terra, where there wasn't an underlying lack of trust in the exchanges, right? So they understood that Terra was a problem in 3 hours, but they didn't sort of fear necessarily for the viability of the exchanges.
Yes.
Now they do.
Yeah.
So they've all withdrawn funds.
Yes.
Right? And
Yes.
they've sort of basically done the equivalent of bank runs. Right. And what's interesting is that some of them have gone through this and have done okay, because they've met all their withdrawals and they've done what they had to do, which means actually those companies have basically survived this stress test. And the ones who haven't, which we can see very quickly, have started to halt withdrawals and said, oh, you can't do this anymore because turns out we don't have all the assets here. We got to deal with this, right? So this is a little bit of this sort of weeding out period. And so I actually think confidence will be rebuilt because now, first of all, from a risk standpoint, I can assure you that every exchange out there is going to say, no, we're not going to do this kind of stuff, because not just from obviously the right industry practice, but just from a risk standpoint, because they know that their customers are at any time going to want to withdraw their funds. I also think that the customer has become wiser for it too. They've become more careful and therefore more savvy and more aware out of this exercise. So I think again there's a positive. So there's some of my say peers who are saying this is going to be a long drawn out winter. It's going to be a really, really difficult time. I agree it's going to be difficult, but I don't agree that it's going to be that long drawn out. Because what we've seen, if anything, in the blockchain space, these cycles happen really in dog years as well, right? So we've gone through a crash. The recovery will actually, I think, happen as quickly as the crash took place as well. A lot of people, when Terra and Luna happened, were basically saying, this is the end of crypto. We're going to have a multi-year there's a macro effect on top of it. And then it turned out that actually, just before the FTX saga, actually sentiment was great. Institutions came in. Yes, the prices were a little lower, but the merge happened successfully. Everything was still going on. So, and then even for us, right? Despite everything, we just did a football-related drop with Cool Cats, and that was this morning, and it sold out, right? And so that's interesting.
So people still buy. People still
because the people who buy these type of assets or who play in the metaverse aren't necessarily the people who trade, right? So underlying, right? So if you're buying and using it for the purposes of speculating and making money, sure, you wouldn't do it.
But because you got burned.
Because you got burned, or you want to be careful, you don't know where the market's going to go. But if there's underlying utility, if you want to own the assets, if you can use them in the game, what does it matter if the market is bad, other than whether you can afford it? If you can afford it and you're doing it for your enjoyment because you love it, then it really doesn't matter. I mean, is luxury sales down? Yes, but are people still buying luxury assets? Of course, right? People buying less real estate? Yes, but they're still doing it. People still buying cars, people still buying clothes, right? So at the end of the day, this is where we think the majority of our digital existence will be, which is to basically sort of use our assets as we do in real life, but in a digital world, not for speculating.
But a lot of people did lose money, right?
Yes.
I think the issue with FTX is a lot of retail investors might not have lost on the coins they speculated, but they lost the actual money that was sitting in the accounts.
Yes.
That was through fraud.
Correct.
I think what happens was that a lot of people will say, oh, I don't want to touch this anymore.
Sure.
And then
that will happen.
And then I think I worry a little bit about institutions. Like, would they kind of pull back? Because there was a period that we're seeing that institutions started going into the space, right?
That's right.
Validating the space.
That's right.
Banks, various institutions coming in and saying, okay, we're going to start accepting stuff in Bitcoin and things like that.
Yes.
Do you see a reversal of that now?
So we haven't. So first of all, there's a reversal in everything in terms of everyone's just wait and see, right? Including ourselves, just in terms of, But we're still committed. We just want to see what happens to the market before we start coming back into it. We do know that there's a number of offices who have the same view. But is it possible that they're going to invest less? Is it possible that they're going to be more conservative? For sure, right? Also, I think that there will be people who have been rattled, right? And they're going to wait on the sidelines. However, the good thing is that the number of people who have entered the space still is a very small number, right? So for instance, what happened in Japan, the whole way that the FTX news is displayed in Japan is viewed very differently. It's like, hey, we have regulation, our exchanges are doing really well, right? And in fact, everyone there is talking about committing to put funds into the metaverse, right? And committing to put stuff in blockchain. Okay. And frankly, now is a pretty good time relative to, say, a year ago, because prices are lower, there's an opportunity space as well. So they're embracing this. And if you look at the Middle East, for instance, it's the same thing, for instance, right? So I think it's relative to the market, right? And it's tragic that many people got hurt in the process.
Yeah.
But in the scale of the sort of global presence, the number of people who still are sort of crypto curious and want to get involved, Reddit, for instance, dropped 3 million NFTs on their users. And Reddit used to be very anti-NFT, right? And that drop basically transformed them into pro-NFTs, for instance. And now millions of people who didn't know anything about digital assets are now understanding the space a little bit. And of course, what was their first experience? They received something for free, right? And which is basically, and learned about that. And this is exactly how I think the space will develop, whether it's through games or through culture, but generally speaking, that's the healthier way to do it.
Yeah. Now, for me, who's a little bit older, I remember the .com days.
Sure.
And it kind of feels strangely similar.
Yeah, eerily similar.
It went to the same thing. There was a lot of people who, who put money into anything with a .com on it.
Yes.
And it was .io this time around, right?
Yes, yeah.
And I would say 95% of the companies went bust, around 2000, right? When the bubble bursted, money went out, went dry, and they're out. But then there was that 5% of the company who, Tencent, Alibaba, Amazon, Yahoo, all these guys came out very, very strong and come to dominate the industry.
Yes.
So I assume you're probably thinking the same thing, and this is...
Yes, so our philosophy is a bit different in terms of the dominating perspective, but we do agree that if you can shake out in this winter, particularly because it was already a pretty chilly breeze 6 months ago, right? And if you can manage both of these, then I think...
And survive.
And well, not just survive, but actually grow and thrive. Actually, to me, that's an indication that these are strong companies, right? Because it's not just whether they manage their risk appropriately, it's the fact that fundamentally as a business, they're strong. That's why they can actually survive these type of crises and have the right principles in mind. And we can see what these companies are today, right? Some of them are beginning to emerge, like in our portfolio, one of our first big investments.
Yeah, it would be great. Can you talk about some of these?
Yeah, OpenSea, for instance, or you look at Matic or with Polygon, right, for instance, or if you look at, for instance, even Dapper Labs. Yes, they did some of them have done some restructuring, but they did it basically to ensure that they have a long runway and they also have the right mindset and they've got lots of customers, for instance, right? Or for instance, Sandbox, for instance. I mean, Sandbox is doing incredibly well, right? Everyone's still talking about sort of, their drops sell out, right? Customers are launching on the Sandbox for experiences. People are growing their team sizes who build metaverse experiences for the Sandbox. And it's actually not that dissimilar from emerging markets, because what the metaverse still represents is an emerging market. It's new customers coming in, new economies, new business. So you don't have a saturated market space. So if you're building in a space, maybe you don't make a multi-million-dollar drop, but you can still make $1 million drop or hundreds of thousands of dollar drop, which is actually still much more than you would do, to say, in the physical world, for instance. So the economies are there. And also, I think for younger people as well, this is their space, right? They're excited about the space, they understand it better, and they're building in that area. Not just speculating, but actually experiencing it, building, working, or actually earning. Right? So the number of people that are making sort of, in some cases, their primary income, or certainly a side hustle, acting in, being in the metaverse, is growing as a number, for instance, quite significantly. So I think all of this is sort of demonstrating actually the real value. Now, as an investor, our position is that we have now over 380 investments in the space, and we only have a very small number, like single digit at the moment, that were severely impacted by FTX. Now, that's partially because we were not as heavily invested in the Solana ecosystem. So it's an ecosystem thing as well. Probably investors who were heavily exposed to the Solana ecosystem probably are going to be more affected because FTX and Solana were quite tied. So, out of happenstance and circumstance, we have very limited exposure to that. But the principle as to how we invest, because we're not your typical VC, we invest mostly out of balance sheet, is that we want to, we believe in sort of the shared network effect that is Web3. Meaning that the parallel that we often give is like open source. Open source that's open information, open knowledge. Imagine if open source wasn't just sharing the information, but actually being able to share in the value of that information sort of across the very first developer who created that code, for instance. That to us is what Web3 represents as well. So that means that that piece of code that was created years ago and that ended up creating Huawei and Lenovo and Google and all these companies, those contributors could perhaps also benefit in that. That's what we mean in the shared network effect. But in Web 1, that wasn't possible because there was no way to transfer that sort of value layer. But in Web 3, you can do that. So if we believe that to be true, then the perspective we need to take is that we can't assume that there's going to be a winner-takes-all approach, which is what sort of the Web 2 world looked like. Because data is an open paradigm. It's not a closed paradigm. Then we have to sort of look at it from an ecosystem approach, we think, which means to invest broadly in ecosystems that can benefit each other. So it's kind of a little bit like a sort of rising tide lifts all boats type of approach, which we also think is more sustainable and healthier. And I think most people would prefer to operate this way. Imagine, for instance, what Facebook would look like if actually a large part of their profits actually went to back in investing in the very companies that build on Facebook, for instance, right? Or if Apple took a single-digit percentage of their cash position and actually reinvested it back into the ecosystem that makes apps, for instance, they would be bigger than Andreessen Horowitz as a fund, right? And Sequoia put together.
Right.
But what would it mean for the ecosystem? It would be healthier, it would be stronger, it would be better. But instead, they extract all that value, keep it somewhere in Ireland, and don't fairly distribute appropriately.
Right.
And again, we're not saying this is still capitalism, right?
Yeah.
But it's just the distribution of the capital becomes so lopsided that it creates the problems we have in the world today. And so we think Web3 rule is changing that, and that informs part of our philosophy in terms of how we invest as well. And we see this as well when people join the Animoca family, like when we did the investment in Cool Cats. Then a number of our portfolio companies and everyone else started participating in the network of Cool Cats by owning a Cool Cat or whatever. It created trading activity, it created excitement, it created new customer relations, and it helped grow, and it really created a network effect that participants could benefit from. Obviously, we're still a little while away from making this sort of more systemic. However, that is the path that we want to see happen. And so as a result, I feel like that's why I would describe SBF as the enemy of crypto, because he doesn't actually embody that vision at all. He did it really just to centralize power to himself, clearly.
Yeah. I remember you mentioned Meta. I suddenly remember that 15 months ago when we first talked at the Columbia Morningside Salon.
That's right.
I asked you a similar question. You said, what happened to Facebook? Is it going to disappear? Or, you mentioned the same thing.
Yes.
And it's funny that now, 15 months on, but just looking at the share price, I think the shareholders of Meta kind of voted with their feet.
Right.
But what is going to happen?
But if you look at the performance, right?
Yeah.
I had actually gone out and said, spending $10 billion on how Facebook wants to build the metaverse is simply not enough.
Right.
Because if you're, for instance, building in the open metaverse, you can obtain 95% of the value, right? Why do you have to share 50% of your value, or in some cases more, to the platform? That's a heavy tax, unless it gives you all the benefits that are commensurate to the tax. Like some of us may prefer to live in Sweden or in Scandinavia, for instance, because of all the extra services we get. All right, we pay that tax, right? But what is Facebook giving you relative to this? And that's also the reason why people are starting to rail against the platforms like Apple, for instance. It's not okay to charge 30%, because the value that Apple gave for that 30% 10 years ago was very valuable. But today, it's actually not valuable at all. It's the same thing around, just because it worked 10 years ago, it doesn't mean it works today. Because 10 years ago, the distribution model, that 30%, the value that Apple generated for that 30% was very fair. But now that they've consolidated these network effects and these controls around them, the 30% has simply become a membership fee, a privilege to be there. And they haven't innovated to create more value for paying that 30%. And if they did, whether it's through investing, whether it's through marketing, whether it's through other aspects, it's like a publisher, right? If I'm a publisher, I can't just have the privilege of being the publisher. I need to work for it. So what is Apple now doing? 10 years ago, Apple provided discovery. That was its biggest value. If I put an app on the App Store, I will get lots of downloads. 30%, no problem. Today, you put an app on the App Store, you get nothing, right?
Right.
Nobody will download it just because it's on the App Store.
That's right.
So its value is diminished. So you would still pay a fee, but is it worth 30%? And that's the point here, which is that value, it's okay to charge 30 or 50 or 10 or whatever percent you want, but it has to be fair. Otherwise, why would the other person embrace it? And so for Meta, that's the problem.
Yeah.
But they have another problem, which is that not only is 50% too much, or 47.5% to be precise, it's also that they need to charge this to be sustainable. Because they're basically rebuilding the entire metaverse from within.
Yeah.
So they have to build what blockchain already has. They have to rebuild and open their own ecosystem, which is currently already existing, which is why it can do it, which is why Sandbox can give out 95% of the value, because we don't have to sort of shoulder the cost of the network.
Yeah.
That's why I think Facebook can't work for Facebook, right? And I think we spoke about this earlier, and I said, I don't think it's going to work. And lo and behold, here we are today, and they're struggling, and they let go almost 11,000 people, right? And I think for Facebook, they should just simply open up. They should just simply say, you know what, we're going to build the open metaverse. We're going to integrate Facebook on blockchain somehow, right? We're going to figure it out, and that would be the path in which the future is seen. And I think deep down, Mark gets it, because he has, tried to launch Libra.
Yeah, it didn't work.
Well, it didn't work because of regulation.
Regulation.
Right?
Okay.
Government didn't want him to do
Right,
it
right.
because historically Facebook has been such a bad actor. And also because two of the biggest newest blockchain, Aptos and Miston Labs, have all emerged from Facebook. Right? These are basically came from Facebook Labs, and when David Marcus was like, I can't do this here in Facebook, he left. Then basically the entire blockchain team sort of left and built their own stuff that emerged originally from Facebook. So again, he does get it, I think. It's just that he is in a bit of a pickle because he can't fully embrace it for all the reasons. Maybe it's also shareholder pressure, a classic innovator's dilemma.
I mean, this is actually funny because what you just said literally sounded like Kodak, the Kodak moment,
Right.
Isn't it?
Yes, in a sense.
So now Facebook's in that Kodak moment?
Well, I think they're fundamentally stronger than Kodak was at that moment in time. But I think they are facing somewhat their Kodak moment because, and I think blockchain is, by the way, blockchain isn't just a Kodak moment for Facebook. It's a Kodak moment for almost any Web2 business because eventually I think they'll all be disintermediated by the open network.
Wow. I mean, basically what you're saying is just we should be expecting another revolution almost coming on
Yes.
with social media, with all this, a lot of these mega platforms who have been dominating,
Yes.
for the past 20 years,
Yes.
both in terms of their influence as well as their financial influence, right?
Well,
The
you
stock
have to,
market, things like
that's
that.
right. You have to think though, what is it that actually gave them dominance? And they gave them dominance because they have basically a data monopoly.
Yeah.
Right.
Yeah.
Now, that's what blockchain fixes. Because whatever was, and also, if you think about it, if actually all transactions were in an open network with FTX, for instance, and we were actually transacting on-chain as the promise of blockchain should have been, none of this would have happened. Because everyone would see what's going on. Everyone would understand what
Right.
where the wallets are.
Yes.
And if there's funny movement, everyone would react to it. Right?
That's what I was
Exactly.
thinking, to be honest.
That's
I was like, you're supposed to be able to see where all these things
Exactly.
are going.
Exactly.
Like if somebody stole my coin,
exactly.
I should be able to see where it went.
Yeah, and so the one of the other effects that I think most people haven't realized in, let's call it mass media, because they don't look at this stuff, is that the big exchanges, like Binance, for instance, have actually gone out and exposed their wallets. They've said,
is that right?
They've gone out on
Did not
public
know.
and said, these are our wallets, this is our cold storage, you can take a look at it, and this is our proof to you that we're real, right? So outside of regulation, they've done this, right? I think Crypto.com has done the same thing, right? And Coinbase and so on. So they've now all gone out because how else do you instill customer confidence,
That's right.
right?
You gotta.
So you got to show. And now if something funny happens in that wallet, you can imagine the whole world's looking at those wallets and saying, oh, why did you just move, $100 million? You have to explain. So I actually think it's a positive step. It's just a shame that it had to happen because, a bad actor blew up the way that it did.
Everyone said Binance did this on purpose. In the remember the beginning. Remember the beginning, right? CZ did this on purpose, and it was the best way to quickly destroy a competitor. Is that actually what you think happened?
No. So, I mean, first of all, that there's competitive friction. I think, of course, there is competitive friction, and in reality, if people withdraw their funds from FTX, would FTX be weakened? Yes, of course, right? So you could argue that there might be maybe some kind of competitive undertone. But I would find it extremely, extremely hard to believe that Binance or CZ, for that matter, actually knew the level of incredible fraud. Like I think nobody knew just how endemic and how problematic FTX was.
Right.
Because the knock-on effect was just so big, right? So and by the way, exchange competitors always knock on each other, right? It's part of the course, shall we say, right? And I think this is, if I had to make an assumption, if people withdrew a lot of funds from FTX, then yes, FTX revenue will decline. There'll be less liquidity. They make less fees, so it does give them a little bit of a headache, sure. But I don't think anyone in their wildest imaginations would have thought that there was basically skeletons and zombies at that scale, right? I think that's something that nobody expected. So I don't think he intended to destroy them in that particular fashion, right? I think that would be I don't think so.
Yeah, but nonetheless, I think they now become the strongest exchange out there in the world.
They have, and
yeah.
I think also as a result, they have now demonstrated that they need to be more transparent than ever.
Right.
Which actually I think is a positive for
It's positive for the industry, for the people still involved.
Correct.
Given what's happened, what would be your advice to entrepreneurs, people involved in the industry today? What should they do given what happened from here on?
Well, I mean, I think just if you look at ourselves as an industry, when we started in 2018, that was the crypto ice age, right? I mean, Bitcoin was like less than $3,000.
Yes.
You know, ETH was hovering in the low hundreds. I think at one point it was under $100, for instance, right? And everyone was running away. And it was for similar reasons, because of the fact that people were only speculating, and when Bitcoin came crashing down, everyone was gone. And that was really, really bad. And yet this is where we started to build. Because actually, that's how we got involved with OpenSea and Sandbox and those ones. That's how we started building our first NFTs and these assets. And it may seem, wow, that was so long ago. That was only 4 or 5 years ago, right? And I think everyone knows that building a business takes a long time.
Yes.
To me, the fact that we are at this position 4 to 5 years later is incredible, actually, right? To me, the kind of development that we're seeing could be something that might take 10 years or more, for instance, right? And I think if you're a true builder, you are not actually deterred by the fact that it would take a long time. Because if you believe this is the future, if you believe this is the right thing to do, then you'll do it anyway. Because not just because of a potential opportunity and prosperity, but because as a business, actually, it's a right pathway. The early days of any sort of early mover is like this. When people got involved in the internet in the early 90s, it wasn't really, if you think about the full promise of the internet, took actually decades to develop to where it is, right? And then, but because of the pace of technology, it accelerates. So when mobile started coming out with a smartphone, actually when Apple first came out with a smartphone, it took probably 5 to 6 years for it to really begin to demonstrate the actual full promise, and now it's everywhere, right? And I think again, with Web3 and blockchain, we're kind of at that same stage. But because of the financial element, you have these crashes, but fundamentally, we're still talking about trying to onboard 5 billion people online to Web3 in a space where you still only have tens of millions of people, comparatively speaking. So that's the opportunity profile. The other thing is, of course, that when you have a market that is the way that it is right now, it is much easier to hire, fundamentally.
That's right.
And this is the other thing, right? Even for our own history, when we started Outblaze, right, which sold its messaging business to IBM, we started it in 1998. Right? And one of the reasons it actually worked to hire and begin the business in 98, even though the market was really, really, really bad, right, is because we could hire people at reasonable salaries.
Less competition.
Less competition, for instance, right? And so I think these events actually make you stronger and give you actual valuable lessons that you wouldn't otherwise. If you build in a bull market, everyone has success, but you can't actually underlying see why you were actually successful. Because it's just the macro, right? It's actually in these times where you can really identify the true strength of a company and also the true strength of character of people who are building in the space. Because I think people building in a bear are purpose-driven people for the most part. Because if you were just here to make money, then there's many other ways you could probably do it faster. But if you are actually really committed to the space, if you believe in decentralization, if you believe in this vision of a fair and better internet, then it won't matter that it takes 1 year, 2 years, 3 years, or even 10 years, because that's really your life's work. So, if you're an entrepreneur, I think the most successful and the greatest entrepreneurs are the ones who build for a purpose greater than themselves. And I think this is the journey that I think most entrepreneurs wish to be on, I think. And you won't necessarily, and this is the same true for us, we didn't start the business to end where it is and continuing to where it is today. I didn't know exactly where it was going to be 5 years from now. I knew what we needed to do in terms of decentralization and true digital property rights. But would we end up this way? I had no idea. And it wasn't really the most important thing. Right? It wasn't part of the plan to have a big valuation and to have 380 portfolio companies. It was just to execute on the mission of true digital ownership. These are the strategies we had to do. And eventually we landed in that space. I think you'll find that to be true for almost any business in the world.
Very well said. Very well said. Remember, your mission and your goals. It's not just about the money.
That's right.
That's what you say. Great. Well, thank you. Thank you for your time today, and thank you for giving us renewed confidence in the industry that we should keep going. So
thank you.
Thank you very much.
Enjoyed it? Please follow our Patreon channel to learn more about international business, entrepreneurship knowledge, latest innovation, and scholars' insights, and even more. See you soon.